Hello traders, it's Tuesday, July the 15th. This is John Kicklighter, Chief Strategist for DailyFX.com. Here to give you FX market wrap-up for the past and opening 24 hours of this trading week, as well as an outlook for what we can expect in the 24 hours ahead of us. This opening 24 hours was relatively quiet, though we did have some noteworthy moves, not with the volume and the volatility that we'd expect, but certainly little modest moves. More of this back and forth that we had in the opening 24 hours, however, was a adjustment in the lead up to expectations of much bigger waves in the forthcoming event risk. Now, the docket ahead, and not just the next 24 hours, but the next 48 hours, is riddled with high-level pieces of event risk. And if I had to choose one particular currency pair for being in the middle of it all, it would probably be the pound dollar. Now, as you can see in this past 24-hour session, this actually did make an interesting move. We had a slip below the 171 figure, which is recent support that we've had going back to the day that we actually broke above it. That was actually July 1st. But it doesn't really come with the kind of reversal and momentum that we would expect. As I said earlier, you can see that there wasn't a lot of volume behind it, and we definitely didn't carry much momentum to the downside. That kind of pullback, but lack of conviction, is exactly what we would expect if we have high-level event risk in the immediate future. It's exactly what we have. Now, before I start looking at the UK and US event risk and talk about the potential there, it's important to recognize that this pound dollar pullback is exactly the kind of circumstances we would look for when we're transitioning from a relatively quiet period into a more active period. The market is more inclined to correct or pull back or balance itself before the major event risk hits. Now, we talk about this on a regular basis. Whenever we come to a piece of major event risk like non-farm payrolls or a central bank decision like the ECB decision, we often see markets either consolidate or correct a otherwise aggressive move in one direction to offer some of that balance, to give a springboard to different outcomes, bullish or bearish, should they come out that way. All right? And that's exactly what we saw, not just in the pound dollar, we saw it in the Euro USD. We saw it in the Aussie USD. Right, we saw it in dollar yen and all the other yen crosses. And we definitely saw it in US equity as a benchmark for the risk on, risk off type theme. Right, or just a balance of motivations for investors looking generally for higher returns versus looking for some measure of safety. This rebound put the S&P 500 right back into the middle of its past week, 2 weeks range. Doesn't necessarily forge a new bull trend, nor does it actually give over to a consistency in the bear trend. It just puts us right back into neutral territory. Much of the correction that we saw from the S&P 500, which is oftentimes the preferred measure that I have when really assessing the sentiment behind the markets, because it is so exaggerated on one side, more of a cued in risk on type measure, doesn't really do well on the alternative, but we can look at some of the other indexes around the world, and I think particularly the European indexes where the biggest drop had been occurring this past week. We've been following and tracking the very sharp declines that we've had here in the Spanish bourse and even the German bourse, the DAX. All right, that has had a similar pullback, but I think that few were as aggressive as Portugal or even to some extent Italy's. All right, their pullback was of greater substance and very substantial technical development. All right, break to the downside here for the Italian bourse. But that pullback also means that if there's a moderating move, the more aggressive the decline, the more substantial the moderation or the correction. Now, it doesn't change trend, just like it doesn't change trend with anything else, but it does give us the biggest, quote-unquote, check. All right. So, with that sentiment in place, right, the preparation for the upcoming event risk, what are we watching? Why is the pound dollar my greatest focus for this upcoming event risk? Well, it's because the data that we have on the immediate docket really has the greatest influence, the greatest pressure behind the pound dollar. As you can see here on my Manic Crisis calendar, I have two particular pieces of event risk that are highlighted. The UK CPI, or inflation figures. It's not just CPI, it's not just consumer prices. It's also producer prices and retailers' prices and housing prices. A broad view of inflation in the UK. And on the other hand, we have the Fed Chairwoman Janet Yellen testimony, her semi-annual testimony before the Senate, the Banking Committee. And this is our opportunity to see whether there's going to be an upgrade from her perspective on the outlook for the taper and the progression into rate hikes, and whether the U.S. Central Bank thinks that there is a impending economic stall, or potentially if there is a bubble that they may have to react to. We certainly have seen quite a few Fed officials voice concern about the complacency in the markets as of late. We'll see if she actually has similar sentiments. All right, but these two pieces of event risk have a much greater influence over the pound and over the US dollar, thereby making the pound dollar one of the most risky currency pairs for event risk. Now, it's interesting because this particular currency pair has not been very sensitive to event risk because it was more risk on, risk off in the evolution of volatility measures over this past week that was really taking the lead on the market. But as we saw, volatility has pulled back. Volume has reduced on the S&P 500 and other risk-based measures. So it's kind of a moderation of that theme and a return to interest rate speculation, a much more aggressive possibility. So what are we looking for in this event risk, and why are these particular pieces of event risk important? Well, I cover that in much greater detail in today's strategy video, so you can see the potential and scenarios that I run down and why one outcome has a greater impact than the other outcome, but I'll do very brief synopses of this particular event risk for the pound dollar. So in terms of the UK inflation figures, this is noteworthy because we know that the pound has really outperformed most of its counterparts. And that's not just the pound dollar. That's similar for the euro pound. That's similar for the pound yen, which these pairs might have some risk element to it. Even pound Aussie has seen greater performance from the pound than the Australian dollar. Same with the pound CAD, and even with pound Kiwi, a currency that is actually seeing its interest rates rise. Now, this performance has a lot to do with those interest rate expectations. And I say expectations, not actual interest rate policy. They have not changed their monetary policy since the last time they cut rates and introduced the asset purchase program. So what the market is actually running on is expectations, forecasts. And those forecasts are pretty aggressive. That's why we've seen the 2-year yield differential between the UK and US advance to such high levels. And similar with LIBOR rates or rate swaps, they have a similar kind of reflection, that interest rate expectations for the British pound are very buoyant. All right, they have good reason to be. Economic activity has returned. The Bank of England has steadily removed itself from its dovish rhetoric, and it has started to warn that rate hikes are possible. However, they have been very opaque. All right, they have not been clear at all, not giving us a clean read, and where they on one hand say something like, we're going to be very reticent to hike, we're going to be very accommodative through the foreseeable future. At the same time, they, let's say a week later, offer up commentary like those from the bank head Mark Carney that suggests that they're surprised that there isn't more rate hike speculation for 2014 in the market. Right? These are very confusing sentiments and statements from the central bank, and it certainly has kept the market on its toes, but it still maintains a hawkish bearing for the British pound. Now, continuing this outlook, this expectation, we already have an upgraded interest rate forecast. We know that the markets have positioned the pound as being one of the most hawkish leaning currencies. So it's kind of difficult to generate further aggressive advance. It's not difficult to actually get a progression to the upside. It's actually quite easy, considering that that's the prevailing trend and the fundamentals have been leaning that way over time. However, a big move to the upside is much more difficult to generate because we already have priced in quite a lot for the pound. Alternatively, it's much easier to see a big move to the downside if there is something that undermines those interest rate expectations, and inflation figures are the thing that can absolutely do it, because we see that those rate hikes expectations, those hawkish bearings from the central bank and evolved through market forecasting, is very much contradicting the inflation pressures that we have seen as of late from the UK. They've actually been softening quite a bit. So if those inflation figures continue to soften, it's more likely that interest rate expectations are going to fade, all right, rather than the markets just wait it out until inflation eventually returns to meet their expectations. In this instance, fundamentals are much more robust than speculation is likely to be. All right. Now, this is going to be a very noteworthy possible driver for the British pound in the sense that we could get a dovish outcome and inflation really misses. I'll be watching the pound dollar, although this also has a lot to do with what happens to the US dollar, although I think that there's probably going to be a status quo sentiment around the US dollar, and there is more likely to be a hawkish lean for, or at least a response to a hawkish lean from Janet Yellen, and less of an impact from a dovish lean. So that actually presents the pound dollar as one of the greatest potentials, right? Not necessarily probabilities, but potentials, has the biggest impact possibilities in those scenarios. But other pairs that I'm going to be watching from the pound side, on a pound disappointment, all right, I certainly like the pound yen, all right. This definitely has a lot of reversal potential to it, but the continuation to the downside is likely to be limited because this is a currency pair that is much more cued into risk trends. All right. I'll also be watching the pound Aussie, where the interest rate forecast for the Australian dollar is just starting to recover, and the pound CAD, which is very much like the US counterpart, though I wouldn't expect too much momentum here. But what about the alternative? What if there is an upgrade in interest rate expectations for the British pound? We know that there isn't a lot of untapped room for the pound in that respect. So continuation, we have to really find somewhere that amplifies its potential. I think that maybe a short-term opportunity for pound Aussie, though I don't really see a lot of follow-through in this. I think that much more interesting is euro pound, because the euro itself has been experiencing a lot of its own issues. If you want to see continuation, there's also a very clean technical channel around 80, which is the current resistance point for that. So that's going to be one of the biggest pieces of interest that we have, and it comes up in today's London session. We'll also be watching Chairwoman Janet Yellen's commentary, her testimony, because this is going to really weigh in on the expectations from the market's interest rate forecast for the U.S. Now, unlike the U.K., where it's very aggressively hawkish, the U.S. is actually seeing the market undermining and undercutting the Fed's own rate hikes, or at least their hike schedule. Their forecasts for 2015 are a benchmark of 1.12%, and their benchmark for 2016, 2.5%. All right, the markets are well below those objectives or those forecasts, given the Fed fund futures. This offers a lot of opportunity, and it immediately says that the U.S. dollar is significantly depressed. Now, it has reason to be depressed if interest rate forecasts are like this, but it's easier to get the interest rate forecasts to change, all right, given the circumstances. But we do have to see something really improve in favor of those interest rate forecasts. We have to see reason for the U.S. dollar and its speculators to cover that gap between the Fed's bearings and the fundamental outlook and where they're currently positioned. If that's the case, if we do see an upgrade, we can see the dollar potentially rebound off of this range support and make another go at what is a longer-term trendline resistance. All right. This is a good opportunity for certain pairs. I do think that the pound dollar, given the proper outcome from the British pound, is a good opportunity in this regard. Of course, if we have a dovish or bearish outcome for the pound and a hawkish or bullish outcome for the US dollar, that'd be a perfect combination. that would probably leverage or amplify a bigger move to the downside for pound dollar, but that's perhaps a little bit too specific of an outcome, and that scenario together is probably a lower probability. Very difficult to actually get. I don't necessarily need as much or as precise a fundamental outcome for Euro-USD. I think that this is definitely a currency pair where the euro itself is facing its own issues. We talked about these more extensively last week. European equity markets, led by an uncertainty in Portugal, that has really led the financial benchmarks, the euro stocks, especially the banking sector there, to see a big tumble. Uncertainties around what's happening with the stress tests that are going on with the banking system. Right, that opens up, once again, a crack, a fissure of one of the more troublesome issues back in 2009, 2010, 2011. We also have the sovereign uncertainties, how the financial stability issues are really sparking a risk theme, and how the appetite for high-yield periphery government bonds like Spain and Italy and Portugal have really leveraged up the euro's sensitivity to that theme of risk and risk aversion. All right, that is another concern that's coming. And of course, there's always the troubling issue of interest rate expectations, right, or monetary policy expectations, where the Fed is going towards taper and eventually talking about its rate hike. The ECB is still adding on new measures. All right, while we haven't seen the ECB's balance sheet take a turn and start to expand, we know it will in September, December, when they do their targeted LTRO auctions. Furthermore, we heard Draghi this past session doing his quarterly testimony, and he was striking a very dovish chord once again, warning that they were ready to do whatever is necessary, and QE was very much within the ECB's mandate. All right, that's essentially removing one of the barriers or restraints to taking that next step. It's not guaranteeing that the next step will be taken, but it's warning the markets that it's a possibility. So these are measures that certainly will weigh on the euro as we go forward. Might not be doing it exactly right now, but it will weigh as we progress. We give something like a reason for the US dollar rally, and this is going to be a big potential for not just a short-term move for the Euro USD. I'll be watching 135.75, but potentially for the medium term. That's why I still watch Euro USD below 135 as one of the benchmark opportunities here. Other dollar pairs besides the euro dollar and the cable, I'll be watching the dollar yen, although that's far more risk sensitive, so it's not going to be at the top of my list. The dollar CAD is going to be a pretty specific view of interest rate forecasting and will play out as such. Now, alternatively, if the US dollar does not come out with a good score sheet with this testimony, let's say things get a little bit more dovish. We're pricing in a lot on the dovish side. It's kind of difficult to see a big trend evolve around the dovishness. Of course, it's still a good possibility. If it does, the US dollar may start to trickle lower, and the Dow Jones FXCM dollar index can make a break to the downside. Where would this be amplified? Not necessarily in the Euro USD, because the euro itself is creating its own problems. Pound dollar's up in the air. Though if interest rate forecasts for the pound are robust, then we still have a big divergence. But I think that the best opportunities for seeing this play through in the dollar weakening is something like the Kiwi dollar, which recently broke its long-term rising trend line resistance here. All right, that can play through pretty remarkably, considering that the interest rates are actually rising in the New Zealand dollar. And it really contrasts the US dollar's dovishness. Now, this is a pretty expensive currency, the New Zealand dollar, relatively speaking. And though it has the highest yield, it's not a market where high yields are prized and carry trade is very high. So looking for a currency that's really relatively diminutive for its interest rate currently, and undervalued potentially, the Aussie USD, currency pair we talk about relatively often over the past couple of months. If we do see a downgrade for the US dollar outlook and everything else remaining the same, Aussie USD could see a very good push, maybe even above 95. All right. Now, these aren't the only pieces of event risk. They just happen to be some of the biggest. Other datum that we need to be paying attention to. BOJ rate decision. All right, this is not going to be likely a big mover for the Japanese yen because we already know what the Bank of Japan's policy approach is. They are not looking to upgrade their QE program. They've already said that they are pretty confident that they're going to hit their targets for inflation and that economic activity is going to remain relatively robust. That is a signal that they are not considering upgrading QE. So that big move that the dollar yen and other yen crosses had made, all right, starting in September of 2012, that was a move that's probably not going to be replicated. This actually leaves the yen crosses relatively open, but the catalyst to a correction is more likely to be a risk theme rather than the Bank of Japan move. All right. Aside from that, we'll be watching the Eurozone sentiment, investor sentiment indicators. We'll be watching a couple pieces of event risk from the U.S. aside from Yellen's commentary, retail sales, import inflation, noteworthy. And even the New Zealand CPI figures are noteworthy. But they're not going to contain as much potential as these particular indicators, these high-level indicators. Now, we'll also cover the big pieces of event risk, Chinese GDP, UK employment, and the second round of Yellen's commentary in tomorrow's video. But before I wrap up today, I do want to highlight some really incredible movement in the commodities market. I'm sure you saw it. It was gold's massive move to the downside. Now, using the day change indicator, we saw that this was the biggest move since back here on December 2nd. All right, quite the decline, quite the massive drop here from this precious metal. Now, is this a move that will likely see follow through? Because it has cleared some technical support. All right, generally I would say it was around 1310, but is this something that really has momentum behind it? Well, it really boils down to what the impetus for the move, the initial move was, and it looks to be more speculative than anything else. What would really hurt gold would be a rally in dollar or a rally or a demand in general for fiat currencies. Neither of those were present. All right. A risk appetite move, which did evolve. We did see a bounce in equities, but it really wasn't the kind of amplitude that we saw in the initial decline, especially from European markets last week. So it's unlikely to be related to that. And inflation hasn't all of a sudden picked up. So we don't need an inflation hedge. We look at some of the volume figures and we look at the futures market. This looks to be much more speculatively derived. Now, speculators can carry a trend on their own, but it doesn't seem like this is necessarily one of those times because there isn't a lot of momentum behind it or evidence that there's going to be that momentum there. So instead, we're going to have to look for fundamental bearing. Now, if Yellen in the upcoming session speaks a very hawkish game and, let's say, UK inflation figures pick up, that could be a good reason for the gold decline to extend itself, but that is a very specific outcome. We'll wrap it up there and do our next trading video tomorrow. Until then, good luck trading out there.